Dobar dan svima.
Good afternoon, ladies and gentlemen, esteemed members of the press, members of the Council of the National Bank of Serbia, dear colleagues. It is my pleasure to greet you on behalf of the National Bank of Serbia on the occasion of the presentation of the February 2014 inflation report. I will give a short overview of the developments in the last year, and I will give an overview of the trends expected this year. So we have seen a significant reduction in external imbalances, a decline in inflation and economic recovery. Inflation was declining last year, and the decline was especially pronounced in the second half of the last year. We ended the year with inflation of 2.2%, although inflation was below the lower bound of the target tolerance band by the end of the last year. We expect that inflation will return within the target tolerance band this year, and we expect inflation to move within the target tolerance band this year as well. We have also seen a moderate recovery in economic activity. GDP growth was 2.4% last year. This is somewhat above our previous assessments, primarily because of a better agricultural season. The better agricultural season was the reason why we adjusted the GDP growth projection for the current year. According to our projections, GDP should grow by 1.1%, and GDP growth will be led by net exports. Last year, net exports affected a significant narrowing of external imbalances. The current account deficit was around 5% of GDP last year, which is almost 50% below the previous year, and we expect that this year, the current account deficit will move at the approximately similar level, and we expect a moderate inflow of FDIs. Relatively positive results last year are a good starting basis for the continuation of reforms this year. However, the main challenges that we face regard the pace and intensity of fiscal consolidation and turbulences in the international financial market. What will produce solid effects on economic developments in the current year also include the oncoming agricultural season. I've now asked Mr. Branko Hinić to present to you the February 2014 inflation report.
Thank you, ladies and gentlemen, esteemed members of the press and fellow economists. Positive tendencies highlighted in the previous issues of the inflation report have continued. Inflation is running low, and economic growth in 2013, led by net exports, has exceeded our expectations. The surprisingly steep fall in prices of unprocessed food, notably fruit, has pushed year-on-year inflation in the fourth quarter of 2013 below the lower bound of the target tolerance band. We expect that year-on-year inflation will return within the target tolerance band of 4 ± 1.5% in the course of this quarter, and that it will stay within the band thereafter. As agricultural production performed much better than anticipated, GDP growth in 2013 amounted to 2.4%, thereby exceeding the expected 2%. It is precisely because of the higher last year's base for agricultural production that we have trimmed down our growth forecast for this year. According to the new projection, GDP should grow by around 1% in 2014 and by around 2% in 2015. In the period under review, the international environment was again marked by the monetary policy moves of the Fed. As the US economy stepped up its growth and signals from the labor market improved, as of January, the Fed started to wind down its quantitative easing program. Along the lines of what happened last summer, investors worldwide reacted by exiting the riskier assets of emerging market economies, principally those running huge current account deficits. and in doing so, sent depreciation pressures on the local currencies. In addition to intervening in the foreign exchange market, several central banks responded to these pressures also by raising their policy rates. Our foreign exchange market has not escaped the far-reaching impact of the Fed's decisions either. Namely, appreciation pressures in Q4 were, among others, attributable to the fall in the country risk premium and increased non-resident interest in dinar securities after the Fed delayed the decision on tapering its monetary stimulus in September. Appreciation pressures were also aided by a somewhat larger inflow of FDI, relatively favorable foreign trade movements, and adoption of a new set of fiscal consolidation measures. The main reasons behind the appreciation pressures since the beginning of the year are the start of the Fed's tapering and stronger FX demand of domestic enterprises, notably energy importers. Buying foreign exchange in late 2013 and selling it since the start of the year, the National Bank of Serbia has remained consistent in its policy of intervening in order to ease excessive short-term volatility of the exchange rate. Looking ahead, the main uncertainties in the external environment are associated with the reaction of financial markets to the Fed's tapering of asset purchases, as this will determine the intensity of the effect on emerging market currencies. Closer to home, the economic outlook for the euro area in 2014 is now slightly brighter. After contracting in 2012 and 2013, the euro area economy is expected to grow by 1% this year. Gradual recovery of demand in the currency bloc should have a positive impact on Serbia's economy and foreign trade. In response to deflationary pressures, the European Central Bank has cut its policy rate to 0.25%, and depending on how the situation in the economy evolves, it has hinted at additional monetary easing. Exports declined in the fourth quarter, mirroring lower automobile industry output. Together with a mild rise in imports, this led to a quarterly decline in GDP by 0.5%, seasonally adjusted. Still, looking at the year as a whole, foreign trade flows were much more favorable than in the previous years, which reflected positively on movements in the foreign exchange market. Exports were led chiefly by the automobile industry, but most other branches of manufacturing also recorded a rise in exports. While expansion of the export base represents a positive signal, further reduction of the foreign trade deficit requires new investment into export-oriented sectors. In the fourth quarter, domestic demand of the private sector recorded growth on the back of higher investment in current assets and was also bolstered by a mild rise in consumption, mirrored primarily through growth in retail trade. By contrast, government consumption and investment were on the decline. GDP growth is likely to slow to around 1% this year. The forecast is based on assumptions of an average agricultural season and the waning effects of the automobile and oil industries. On the demand side, it is grounded in the expected fall in final consumption, slight recovery of investments, and rising demand of our main trade partners. On the expenditure side, growth should be driven by net exports, as recovery is anticipated in the euro area. Another factor propelling investments up will be the formal opening of Serbia's accession negotiations to the European Union, as well as last year's low base. Household and government consumption will exert a negative effect on growth, mostly because of the upcoming fiscal adjustment measures. Nevertheless, fiscal consolidation and the announced structural reforms will create room for GDP growth to pick up in the coming years, which should be additionally aided by the further recovery in the euro area. Inflationary pressures in 2013 stayed rather low, especially in the second half of the year, when the average monthly inflation was negative. It stood at minus 0.1%. Administered prices gave a significant push to price growth in 2013, while low aggregate demand and reduced food production costs acted as the main disinflationary factors. Low domestic demand will remain the key disinflationary factor in the period ahead, while inflation will be driven up by the rise in administered prices, coupled with the one-time pass-through effect of the special VAT rate increase. With the onset of a new agricultural season, which we assume will be average, the prices of fruit, vegetables and primary agricultural commodities are likely to go up. Yet, according to our estimates, this will not exert pressure on the prices of processed food, but will only ease the disinflationary effect of the costs of raw materials currently trending low. As of October, one-year ahead inflation expectations of the financial sector have been running within the bounds of the target tolerance band, whereby the impact of this factor changed from inflationary to an almost neutral one. Taking all of the above into account, we expect year-on-year inflation in the ongoing quarter to fall back within the bounds of the target tolerance band and continue to move within this range. Last year's low base will gradually drive inflation up over the course of this year. On average, however, it should stand at around 4% annually, which corresponds to the inflation target of the National Bank of Serbia. The risks to the projection pertain mostly to movements in the prices of primary agricultural commodities and developments in the international environment, as well as, to a certain degree, to fiscal developments at home. Having analyzed the current and expected macroeconomic movements, the Executive Board of the National Bank of Serbia decided at its last meeting to maintain the key policy rate at 9.5%. Assuming that fiscal consolidation is implemented as planned, monetary policy easing in this period ahead will depend in particular on the strength of potential adverse effects of the Fed's quantitative QE tapering program on the foreign exchange rate of the dinar and the country's risk premium. I must reiterate that it is the emerging countries characterized by pronounced external imbalances that have shown to be the most sensitive to the Fed's cuts in asset purchases. In this regard, Serbia has made significant progress. The current account deficit in 2013 was halved relative to 2012 and equaled 1.6 billion euros, or 5% of GDP. We expect the deficit to remain broadly unchanged this year. However, although Serbia's external imbalances have lessened, the need for external sources of funding has persisted. Aware of the importance of sustainable public finances for the country's macroeconomic stability, especially in light of the unstable international financial market, the National Bank of Serbia strongly endorses the government's determination to implement fiscal consolidation measures and structural reforms. Consistent implementation of these measures would boost the domestic economy's resilience to external shocks, while a close arrangement with the International Monetary Fund would help instill investors with a positive image of Serbia as an investment target. Thank you for your attention.
Good afternoon, Mirjana Brajkovic from RTS. Mr. Veselin, a question for you. Since early year, banks have been discussing the recommendation of the NBS to cut the interest rates on the current account overdraft. So what banks are these, and by what percentage are they ready to cut interest rates on the current account overdrafts, and when will these measures take place? I wouldn't speculate about specific banks and about the reductions in the interest rates on current account overdrafts, but the information that we have obtained is that banks are ready to do this, and they have dilemmas as to the application of some provisions of the law on the protection of financial services consumers. Namely, under this law, each amendment to important contract elements should be subject to written consent of the debtor. And there is now a dilemma whether we should whether we should incur additional costs and whether we should require from each holder of the account to give its consent to annexes to these contracts in regard to a reduction in interest rates on current account overdrafts, or whether there is a possibility to bring into a more favorable position financial services consumer in a different way. So this is one of the dilemmas being discussed, and we are talking to banks about this, and we need to see what are the legal possibilities to do this, and then we will issue our opinion on whether it is necessary to invite each person individually, or whether we could do this in a different way when it comes to these reductions. But I would like to know whether the majority of banks wishes to do this, or there are only some specific banks, or perhaps the NBS could issue a recommendation or an instruction that banks need not sign these annexes, or whether based on an instruction banks would be able to do this for all clients. We need to analyze legal possibilities, and this will not be a recommendation where there is a legal gap, where there are some ambiguities in terms of legal provisions. We interpret secondary and primary regulations, and we tend to eliminate such dilemmas. I wouldn't like to speculate about whether this is the majority of banks or only some banks, but these are banks that belong to systemically important institutions, meaning that they have a large number of current accounts in their systems. Gordana Filipovic, Bloomberg. What are the expected FDIs for this year? Then what were capital outflows from early year, which was specified as one of the major reasons for depreciation pressures? And third, if the investor appetite in Serbian bonds decreases, will you consider the possibility of increasing the key policy rate? Thank you. In regard to FDIs, last year they reached around 750 million euros. For this year, we have projected a figure of around 1 billion dinars in terms of this, that is 1 billion euros. If we observe the structure of FDIs, the major portion, around 45% of the inflow, should end in the energy sector, followed by trade and manufacturing. So this regards the FDIs. In regard to your question about capital outflows, what we have seen from early year, depreciation pressures have been partly caused by a reduction in the inflow from portfolio investments and partly from debt repayment by banks. And if we observe the first 1 month and a half, we assess that in regard to portfolio investments, we have had an outflow of around 100 million euros, and in terms of debt repayment by banks, the outflow was around 150, 170 million euros. In terms of your third question regarding the consistency of depreciation pressures and our response to these pressures, right now we assess that these pressures are temporary, and the key policy rate as the main monetary policy instrument serves primarily to keep inflation within the target tolerance band. Under our assessments, inflation will move in the coming period within the band. Of course, we can't view the effect of reduced liquidity in the international market and the impact on our financial markets, of course, but what we can assess right now is that these pressures are temporary. Dusan Hadži Nikolić from Al Jazeera television. People are talking recently about NPLs and about the so-called private bankruptcy. Would that be a possible solution in Serbia, because some other countries have also adopted this solution? What do you think about this? In the past, we have had such initiatives to introduce similar provisions, similar regulations to define the mechanism of personal bankruptcy or private bankruptcy. As the central bank, we are always in favor of creating systemic solutions because private bankruptcy serves as a mechanism for helping a debtor, so to say. But so far, we haven't had any stronger initiatives in this regard. If you observe the structure of NPLs, dominant NPLs are located in the corporate sector. We don't have such a great problem as other countries in the region regarding the default of citizens and individuals. And I believe that this is the reason why we haven't had the need to adopt such a regulation. There is no, this is not a burning issue, so to say. And right now, we don't identify this as a systemic risk, but of course, it is good to have such a mechanism. Any more questions? Thank you for your attention.